Good afternoon, and thank you for joining us for today's web seminar. I'm Karen Weiskopf, the Director of Marketing at First Long Island Investors, and I'm joined today by Robert Rosenthal, our Chairman, CEO, and Chief Investment Officer, Edward Palleschi, Senior Vice President of Wealth Management and a member of our Investment Committee, and Brian Gamble, Vice President, Wealth Management, also a member of our Investment Committee. We hope everyone had a great summer. As we approach our 34th anniversary, we wanted to take this opportunity to thank our clients for their trust all of these years. We look forward to maintaining that trust and continuing to serve you and your families for many more. Before we begin, I have a few quick logistical items. First, all participants are in listen-only mode. Second, after the team delivers the presentation, we will have time for questions and answers. We have additional members of the Investment Committee here in the room for that portion of the call. Please feel free to submit questions at any point. You don't need to wait until the end. At this point, everyone should see a slide with the heading Today's Speakers. If you don't, please type something in the chat window and we'll do our best to help troubleshoot. Finally, our General Counsel has asked that I remind you today's session may discuss the performance of some strategies and that past performance is not a guarantee of future results. With that, I hand it over to Bob.
Thank you, Karen. As you can see from this page, the future has a way of arriving unannounced. And before we get into the heart of our presentation, our thoughts and prayers go out to all those impacted by Hurricanes Harvey and Irma. FLI has contributed to relief efforts for all those that have been impacted on behalf of all of us at FLI and our clients. As you can see from our agenda, we will talk about our current market overview, the trends and the surprises. We'll go into some major concerns that we have going forward, and then talk about a strategy going forward considering the trends and surprises and the major concerns that we have. And at the end of the presentation, we will have more than ample time to answer any questions that you may have. Now, this slide demonstrates that equity markets are quite strong. And we have a question as to whether or not investors are afraid of these heights. We've achieved record highs, numerous ones this year, yet the sentiment to equities is not irrationally exuberant. There is significant skepticism that remains. As a contrarian, we actually like that, as we know there is cash on the sidelines. As you can see from the box on the right-hand side of the page, we've shown you indices for NASDAQ, the S&P 500, and the Dow Jones Industrial Average. And then we've selected 3 dates to look at performance to that point. On August 17, 2007, prior to the financial crisis, on March 2, 2009, the depths of the financial crisis, and then September 1st of 2017, just about where we are today. And as you can see from the box, or if you look at the line chart, you will see that we went down quite a bit during the financial crisis. And then since then, the beginning of 2009, we've rallied significantly to where we are today in 2017. So those who are long-term holders or investors have done very well despite suffering a draconian downturn during 2008 and the beginning of 2009. Now that we've achieved these record highs, we have to ask ourselves the question, are there compelling fundamentals to support the heights of the market and where we are right now? We believe there are, and the rest of the presentation will demonstrate that. If we turn to the next page, we believe the strength of the equity markets is due in large part to strong corporate earnings. And if you look at the bar chart that we have here, if you look at 2006 and 7, slight increase in S&P earnings per share, going from 87 to 88. Then the financial crisis hit. We dropped to 74. We dropped to $61 per share. And then we have escalating earnings from 2010 to the current year, 2017, and the consensus estimates for 2018 and 2019. Now, this significant increase in S&P earnings per share does not reflect any potential tax reduction in corporate tax rates, which we believe is a possibility later this year or the beginning of next year. And we also believe if that rate reduction were to take place, the projected corporate earnings per share for the S&P in 2018 and 2019 would be somewhat higher than what we're reflecting in this chart. Some estimates are that it would add at least $10 a share to the estimated S&P earnings per share. So as you can see, earnings have steadily risen since the financial crisis, and that in large part is supporting the increase in equity valuations. If we turn to the next page, there's another important aspect to look at. Earnings are not just coming from expense reductions. Revenues are key to this increased earnings per share. We'll talk later about synchronized global growth, which is contributing again to the increase in the S&P 500, where there are many multinational companies that are benefiting from growth in China, growth in Europe, and growth in Japan, as well as the United States. But again, corporate revenues are also strong, and that's a key contributing factor to increased earnings per share and increased valuations in the stocks that we hold. If you turn to the next page, we've got to look and see about valuation. It's one thing to have higher revenues, it's another thing to have higher earnings per share, but we also have to do a fact check on revenues to make sure that they're not too elevated. Excuse me. As you can see, PEs are slightly elevated above the average. We're projecting a PE on 2018 earnings of 17. The average has been 15.1 over many years, as you can see. So if you look at the left part of the graph, you'll see that the average is about 15.1, just a bit below 16. You'll see in the period of 2000, when we had the tech boom and then bust, S&P earnings, S&P Es approached 25 to 28 times. And now we're at the 17.7, but based on earnings next year at 17. So valuations are somewhat higher than the average. But one key reason for this are interest rates. As you can see on the bottom of the chart, the 10-year Treasury yield on January 31st, 1985 was 11.2%. Today, August 31st, 2017, the 10-year Treasury is 2.1%. That's a huge difference. We as investors for you, as your investment advisors, wealth managers, always look at competing asset classes to see what makes the most sense, where there is value. Obviously, in 1985, being able to buy a 10-year U.S. Treasury, which at that time was rated AAA, and get an 11.2% return was very, very attractive. Today, interest rates at 2.1 are not very attractive. We believe there is a direct correlation between the PEs that our stocks will get, our companies will fetch, and interest rates. And as you can see, there's a dramatic difference in interest rates when PEs were very low back in the middle 1980s, and somewhat higher PEs today where interest rates are much lower. So what we have are earnings growing, which is critically important, and we have PEs somewhat higher, but we have interest rates much lower. And we believe that valuation is driven to a large extent by growing earnings and where interest rates are. So this is an attractive picture as far as we are concerned and supports the current level of the stock market. You turn to the next page, another way of looking at this. Again, valuations are slightly elevated for this inflation environment. The current rate of inflation is 1.7%. Historically, when inflation is somewhere between 0 and 2%, the average PE has been about 16. So again, at 17, we're a bit higher than the average, but again, we believe that interest rates play a large role in that. And as you can see, if interest rates and inflation went much higher, PEs would track down. But right now and for the foreseeable future, we believe that inflation is quite controlled and should stay at the 2% level or somewhat lower. We turn to the next page. Again, we focus on interest rates. And this chart really says it all. It goes back to 1945. And as you can see, interest rates were very low then. They peaked in the middle, or the beginning of 1980 to 1985 at almost 16% for the 10-year Treasury. And today, as we mentioned before, as of August 31st, the 10-year Treasury was 2.1%. Now, what we do in our evaluation and our attempt to accurately project proper valuations is to take a look at the relationship between the earnings yield of the stocks that we hold, in this case the S&P 500. And right now, based on 2018 earnings, that yield, which is the inverse of the PE, is 5.9% versus the 10-year Treasury at 2.1%. It's actually even lower than that today. This correlation of 5.9 for the earnings yield versus 2.1 for the bond yield is very attractive. And it suggests that valuations for stocks are much more compelling than bonds. A matter of fact, Warren Buffett the other day was quoted as saying that bonds are actually trading at about 45 times earnings if you look at that analysis. So with stocks at 17 times earnings projected on next year and bonds at 45 times earnings, we believe the case is quite clear that stocks are more compelling than bonds today. However, if we think that there's financial repression and that rates are artificially low, even if we were to normalize the 10-year Treasury to 4 to 5%, the correlation between the earnings yield and the bond yield is still attractive for stocks in our opinion. So we've got some very strong fundamentals. We've got low interest rates, low inflation, growing earnings per share projected out for the next several years. They could even be helped if there was tax reform in Washington. And we have growing revenues. And we've got a synchronized global growth situation going on that we haven't seen in years. We'll talk about that more in a bit. So we've got some pretty good fundamentals here that we think support the current levels of the stock market. And with that, I'm going to turn the program over to my partner, Ed Palleschi, who will talk about the makings of a good economy.
Thank you, Bob. There is a synchronized global expansion that has finally begun. Growth is accelerating here and abroad. As you can see in the upper left-hand corner, real GDP, since the recession ended in mid-2009, U.S. economic growth has fluctuated from quarter to quarter while averaging a little more than 2% a year. As the economic expansion has entered its 9th year, there's been some promising trends underway, such as global pickup and growth supporting U.S. exports, rising employment supporting household income and consumer spending, and strong corporate profits and confidence supporting business investment. As you can see to the chart on the right, world annual growth has also improved, and that's been driven by the recent broad-based recovery of the Eurozone economy, solid growth from Japan's economy, along with a major emerging market such as China economy continue to expand at an accelerating pace. All these are the components for the makings of a good economy. If we could go to the next slide. If you consider the growth in corporate earnings that Bob mentioned, the low employment rate that we saw on the previous slide, modest inflation, low interest rates, and a strong consumer who currently has low levels of debt on their balance sheet, and as you can see from the chart below, the price of oil being considerably lower, all these are the makings of a good economy, which appears to have momentum going forward in the latter half of the year and beyond. Consumer confidence is very important as it's a main driver of consumer spending, as consumer confidence, as you can see in the top chart, has risen due to the recovery in the U.S. labor market. And due to that stronger consumer balance sheet, you could see the growth in assets. For the first quarter of 2009, total assets were about $69 trillion. Third quarter of 2007, that was the low. Third quarter of 2007 was the peak at $82 trillion. Currently, it stands at about $110 trillion. The continued uptick in confidence should lead to increasing consumer spending, thus contributing to further U.S. economic growth. In order to have a good economy on solid footing, you need a healthy U.S. banking industry. The U.S. banking industry has experienced its strongest financial health in quite some time, as liquidity and capital ratios, as you can see, have hit all-time highs. banks are indeed well capitalized and will also benefit from a less burdensome regulation. Hopefully that will pass sooner than later. And it's worth noting that all 34 major banks have indeed passed their stress tests. The chart on the right talks about small business optimism index, and that has rapidly risen, which could lead to solid growth in business capital investment, further driving economic growth. So what have been the surprises so far? Well, I think two surprises worth highlighting in 2007 pertain to inflation and the Treasury yield curve. It's obvious that inflation has been going down. You can see that by the chart. And what's interesting is that is the dynamic where, despite the world's major economies producing strong economic growth, inflation has remained low, and expectations for the lack of inflation in part have ranged from increased globalization, with multinationals keeping consumer prices down in efforts to obtain greater market share. Other reasons investors or the experts are expecting why inflation is so low: technical innovation such as Amazon, where new business models are designed to deliver goods and services to lower prices. And I think it's also worth pointing the other big surprise this year is the yield curve. The government bond yields have continued to decline during the year, resulting in a flattening of the yield curve. The yield curve has flattened since the Fed began to tighten, and since it's raised the Fed's funds rate. You could see from the chart below, on 8/31/2007, as Bob alluded to, 10-year being at 2.1 compared to 12/31 of 2013 when it was sitting at 3.9. Most often what ends a bull market is when inflation rises rapidly. In response, the Fed then becomes aggressive in raising rates to combat the emerging inflation threat. So the yield curve is a line depicting the yields of treasuries of different maturities. An inverted yield curve, which is when short-term treasury yields are higher than long-term treasury yields, is a reliable indicator of a looming recession. And it's obviously worth noting that the treasury curve is not inverted at the present time, and we continue to believe that the yield curve will begin to steepen over the next 6 months or so as the Fed begins to shrink its balance sheet and implement another rate increase, possibly in December of this year. So let's talk about volatility, which has indeed hit an all-time low in July. The decline in the stock market volatility has become, during what's interesting, a stable period of economic growth. Earnings have been solid, interest rates and inflation are low, and consumer confidence is steadily rising along with employment growth. Over the past 6 months, the VIX has moved steadily lower, which could suggest that the ongoing political uncertainty hasn't been meaningful enough to impact investor psychology and offset the benefits of an improving global economy. The number of days within the S&P 500 range greater than 1%, the high-low of that particular day greater than 1%, has been few and far between in 2017 compared to previous years. So let's talk about major concerns where volatility could move higher based on some geopolitical or domestic political issues. Certainly some of the major concerns on the table right now are the potential confrontation with North Korea. Not only is there concern on the military front of things escalating, but there's also been talk about President Trump going about it, combating this threat via an economic route where they would cut off trade, and obviously there would be a negative impact if that was to go in that direction. The Fed tapering may result in more volatility. Fiscal policy growth initiatives such as tax cuts and repatriation of foreign earnings, if that doesn't materialize or gets pushed further out, that could cause more volatility in the market. And obviously the threat that we've been living with for quite some time, terrorism around the world, is always out there as a major concern as well. So the Fed tapering, as mentioned on the previous slide, will likely become more aggressive in the next few years. For those who you don't know, the Fed bought trillions in treasuries and mortgage-backed securities after the financial crisis to inject liquidity into the financial system, to stabilize the banking sector, to spur on lending, and basically stimulate the economy by holding down long-term rates. At the Fed's July policy meeting, the Fed announced that it would start reducing that $4 trillion balance sheet relatively soon. Now, the Fed won't actively sell these assets. Instead, it will allow a preset number of holdings to mature every month without reinvestment of that principal. And this expected shrinking of the Fed's balance sheet will be implemented gradually at a measured pace over several years. Now, allowing this balance sheet to decline could contribute to the rise in long-term rates. And it's worth talking about the importance of corporate tax reform. You could look here and you could see the OECD International Tax Competitive Corporate Tax Score is quite low compared to the other countries, other developed countries. It is burdensome. The U.S. corporate tax rate of 35% is the highest among major developed countries and discourages investments in the U.S. A cut to the corporate tax rate, as Bob mentioned earlier, would definitely benefit earnings for U.S. companies. Whether those monies would go back into R&D or to shareholders is to be determined. But President Trump's goal is 15%. I don't think that's an achievable goal. I think lowering the corporate tax to somewhere in the mid to low 20% range is more achievable. Yesterday, President Trump agreed to a proposal which, if approved by Congress, would result in a 3-month extension of the debt ceiling. It's worth noting because this could potentially delay when tax reform can be considered and completed. So is that going to be pushed at the end of 2018 at the end of 2017 to the first quarter of 2018? So that is to be determined. But if there is, I think it'd be quite disappointing for investors and the market if this doesn't transpire into that 20% corporate tax rate. And I think it's also worth noting the signs of a recession are not here. Recessions typically occur under the following conditions. You could see the check marks in 2000 and 2007, whether it's heavy flows into the equity market, M&A activity, rising interest rates, erosion in number of stocks making new highs. None of these conditions are currently thus far occurring in 2017. Thus, the likelihood of a recession is not on our radar. And I think I'm going to pass it to my colleague now, Brian Gamble, to talk about our approach to 2017 and beyond.
Thank you, Ed. We have discussed the economy and the potential drivers of volatility in the market, and I'll go now into how those factors shape our view of the investing landscape and how we position clients for the balance of 2017 and beyond. Many of you have seen this slide before, but this is how we view the investing landscape and our baskets for asset allocation that we customize for each client depending on their specific needs and goals. We look at the world through 4 baskets: security, defensive strategies, traditional equities, and private investments. The lowest risk, lowest return opportunities being on the left, and the higher risk but also higher return opportunities being on as you move to the right, with the far right typically being less liquid than the rest. Our current approach, which has not changed much over the past several years, starts with a diversified and prudent asset allocation. In most cases, we recommend an underweight to the security basket with a focus on quality and short duration. There are not many opportunities in the bond market to earn attractive returns, given what Ed discussed earlier with the flat yield curve, and especially when considering the impact of inflation and taxes. We continue to recommend overweighting defensive strategies, as the market has been on a strong run since 2009, and being a bit more defensive makes a lot of sense given the uncertainties outlined earlier. We recommend modestly underweighting traditional equities at this time. While valuations are not expensive, they aren't cheap either, but maintaining an allocation makes sense. We utilize private investments where appropriate, depending upon each client's unique situation. This chart sums up why we are underweight fixed income. With low current interest rates and the expectation for rising rates, we remain underweight fixed income with a bias to quality and short duration. The Fed funds rate is currently targeted at 1.25% and is actually slightly lower than that today. The Fed expects this to rise over the next 3 years to reach its long-run target of 3%, which you can see on the right. However, this does not match market expectations, which can be seen with the gray line. The market is currently expecting no further increases from the Fed this year and very little in 2018, with one more 25 basis point hike between now and year-end 2019, given these estimates. The wide discrepancy between the Fed and market expectations is a potential source of volatility, as depending on what happens in the economy, one or the other may need to adjust their expectations. If Trump's plans are successful and economic growth accelerates, along with inflation, then the Fed may be forced to raise rates faster than anticipated. Conversely, if growth does not accelerate, the Fed may have to slow its pace of interest rate hikes. Our current approach is to overweight defensive strategies, which are designed to do mainly 3 things: mitigate volatility and minimize downside capture while still participating in significant market appreciation. You can see some examples of defensive strategies that we have listed here, which include hedge growths, which are biased to growth companies, dividend growth, which are biased to value companies, and multi-strategy hedged investments, which are biased towards credit vehicles. This slide here kind of keys the importance of defensive strategies and importance of downside protection, and the main reason why we are overweight our defensive basket. One of the keys to growing one's wealth is compounding, and in order to compound, you need to avoid the big down year. This slide shows the gain required to fully recover from a loss. As an example, the market is down 20%. It will take a subsequent 25% rise from that bottom to get back to break even. The required to gain recover only grows as the loss increases, so minimizing the loss is key to creating and preserving wealth. This slide shows the importance of being invested and not trying to time the market. If over the last 22 years an investor missed only the 5 best days in the market, one would have reduced their compound annual return by a full 2% per annum. And if one missed only the 10 best days, one would have cut their compound return almost in half. This will have a meaningful impact on one's performance and wealth creation and preservation. We have been often asked, how does a market perform during periods of rising interest rates? And I think this chart does a good job of showing what happens during that time. As you can see, the market tends to perform reasonably well as interest rates rise, as evidenced by these 7 periods over the last 25 plus years. The numbers you can see on this chart are the annualized returns of the S&P 500 during periods of rising interest rates, and all look like pretty good returns going forward. I'll now turn it back to Bob to summarize this presentation.
Thank you, Brian. 2017 continues to be a strong year for virtually all FLI strategies and the markets overall. So our clients are pretty happy right now, and we expect that to continue certainly through the end of the year and into next year. Growth in corporate earnings is encouraging and should continue. And if we get some tax relief out of Washington, the growth in earnings should be even greater. But again, as we stated earlier to you, the growth in corporate earnings is key to an appreciating stock market and the companies that we invest in. Valuations in general, as Brian pointed out, are not cheap. But one may say that equities right now, given their valuations, are the best game in town, especially when compared to bonds. As we showed you earlier, PEs have been much higher in markets back in the early 2000-2001 period and came down a bit, quite a bit. Today at 17 times next year's earnings, given where interest rates are, we do not think valuations are extremely expensive. Volatility has not played much of a role this year, but could come at any time. And that's why we have the quote, "The future sometimes comes unannounced." So given the geopolitical situation, given the paralysis that we have in Washington sometimes, given natural disasters that we're seeing with these two horrible hurricanes, volatility could become greater. But volatility is an investor's friend. If the fundamentals are there, volatility shouldn't bother us. International investing is beginning to be a larger contributor to performance. And we at First Long Island, over the last year, have increased our allocation to international in our respective strategies. Concentrated portfolios of companies with strong fundamentals should prove successful over the long term. It's key to remember that we're not investing in stock symbols. In terms of our equity investments, we're investing in businesses. And we try very hard to find really good businesses that have good growth potential, have great valuation components to them. And if we invest in those kinds of businesses over the long term, we will be very successful. Again, there'll be volatility in between. But again, we're investing in sound businesses for the long term. We remain committed to selective opportunities in real estate and private equity. And we'll continue to look selectively for opportunities in that area, given, as Brian pointed out, they tend to be of higher risk and less liquidity, and they're not right for every client. Bottom line is we believe a prudent asset allocation with an overweight to our defensive strategies is the best course for most investors. And that'll give us a good shot at some good upside while being defensive on the downside during those periods of volatility or when a recession ultimately hits, which we don't see for the next few years. In summary, 2017 continues to be a good year for our clients. Our performance is, we think, quite good at this point, and it's supported by strong fundamentals, not just in the United States, but on a global basis. And with that, I'll turn it back to Karen for questions.
Great. Thank you all. So I really appreciate Bob, Ed, and Brian sharing this with our participants. We'll now begin answering questions. We actually got a few that were sent in previously, and we'll start with those. But please use the question window on your screen and send your questions over. We'll get to as many as we can. So first, a question that was asked a couple of days ago was, the U.S. dollar has been weak this year. How does that affect the earnings for companies in your portfolio? And we have Philip Malikoff from our investment committee who will take the lead on that.
So first, thanks for the question. And yes, the dollar has been weak this year. I've been tracking the euro from the beginning of the year, so I was planning a trip to Europe, and it ended last year at about 103, 104, and recently it hit 120, which I believe is a 30-month low for the dollar against the euro. And other currencies have been similarly weak as well. But before discussing the dollar's impact on earnings, I think it's important to analyze why the dollar is weakening, and there are several important reasons for this. First, interest rates were expected to be higher than they are. And as we've seen during the presentation, the yield on the 10-year Treasury remains near historic lows. The Federal Reserve was expected to raise rates as many as 4 times this year, but so far has only raised twice, with no further increases expected until December, and even in that, as we've seen, it's not a certainty. So the Fed has been cautious and methodical in its actions and not as aggressive as expected. Second, there's much uncertainty within our legislative and monetary governing bodies. In Congress, there are questions about corporate and personal tax reform and how sweeping it will be and how infrastructure spending will be incorporated. Regarding the Fed, we're waiting to see when they will begin reducing its balance sheet and how quickly they will move to do so. And we don't know who's going to be leading this important agency when Janet Yellen's term ends next February. It could be Gary Cohn, Kevin Warsh, or perhaps Yellen could be reappointed. Perhaps there'll be someone else. But, the bottom line is there's lots of uncertainty here, and investors really don't like uncertainty as far as the dollar goes. Third, Europe is improving, experiencing faster than expected economic growth. There's reduced political risk with recent elections, and it is considering ending its own fiscal stimulus. Other countries such as Japan, Mexico, China, and even Britain are improving as well. So since the dollar's strength or weakness is measured in relative terms to others, we're seeing the dollar weaken in regards or relatively to other currencies. And fourth, as we mentioned, there are geopolitical issues, our standoff with North Korea being the most prominent at the moment. So at FLI, as part of our analysis of global economics, we interact with outside economic research firms, and they generally believe that the dollar should stabilize as there's more certainty in fiscal and monetary policies over the next 12 to 18 months. And they do see a slight upward bias. But going back to the original question, how dollar weakness affects our company's earnings, the vast majority of our holdings will benefit from dollar weakness. Most of the companies in our portfolios are large multinational companies which receive significant revenues from overseas. As the dollar weakens, they will see earnings increase as their goods and services will be less expensive for foreigners to purchase. Priceline, for example, which has over 75% of its revenues from Europe last year, is an example of that type of company. Johnson & Johnson and McDonald's are others that will benefit as well. Companies with large domestic revenue bases, such as CVS or United Healthcare, will not be affected by a weakening dollar. But ultimately, the biggest losers when the dollar weakens are U.S. consumers, who will pay more for foreign goods and services, both domestically and when they travel abroad.
Great. Thank you so much. The next question is one we got earlier this morning. I think we covered a lot of it during the presentation, but I am going to pose it and see maybe, Bob, if there's anything you'd like to elaborate on. The question is this. With no tax or infrastructure plan on the near-term horizon, with saber rattlings on many fronts, Afghanistan, Iran, North Korea, Syria, and with zero prospects of promised 5% GDP growth, what do you think is holding up the equity market other than liquidity and hope?
Okay. It's a good question. I think the presentation should have demonstrated to all that are participating that strong earnings are occurring without any benefit from Washington legislation. We showed you slides on strong earnings projected for the next few years. We showed you also a slide on strong revenues that are supporting it. We talked about the global synchronized growth, which is happening for the first time in many years, with Europe and Japan contributing, not just getting the growth from the United States, China, and a few emerging markets. So the underpinnings of the earnings growth are in place, irrespective of what the people in Washington do. However, we do believe that there is some bipartisan support for some legislation to at least reduce the corporate tax rate. I think the slide that we showed, which depicts the United States as having the worst corporate tax regime or structure versus other developed countries, is clear to both Democrats and Republicans. And if we do want to create more jobs in the United States and have better paying jobs in the United States, one way to do that is to level the playing field for American companies in terms of their corporate tax rate. Canada, as an example, has a much lower tax rate right across the border, as does Mexico. So we're competing against countries that are treating their companies a bit fairer than ours. And again, we believe that there's sentiment on both sides of the aisle. This is one thing that both sides of the aisle can agree on. Now, whether or not they're capable of getting any legislation, that remains to be seen. But even if they don't, this market is being supported by stronger fundamentals. And one thing I should point out, there was a run-up at the end of last year in a number of industrial companies and also some financial companies that would have benefited from the campaign promises made by the current administration. Those companies, particularly in the industrial area and some in the financial area, have given back most of those gains. So again, the market's not reflecting at this point any legislation. If that were to happen, either on the personal basis for individuals or a corporate tax rate being cut, or if repatriation, which again is rebuilding of our infrastructure, and both sides of the aisle agree that something has to be done there. If any of those proposed legislations get approved and are signed by the president, then we could see some more happiness perhaps in the equity markets in those areas. But as of right now, we don't think there is great anticipation that that will happen. It would be a pleasant surprise if it does. Hope that answers the question.
I think it does. Great. Our next question. You showed a slide earlier that volatility has been very low this year. Do you have any additional thoughts as to why? I'm not sure who wants to take that.
I'll just chime in a few, and then anybody else can chime in. You know, volatility is typically caused by events, some that can be anticipated and many that can't be anticipated. As of right now, again, I hate to harp on the slides that we've shown, but you've got strong earnings growth, you've got revenue growth, you've got low inflation that remains low and stubbornly low, and you've got muted interest rate increases. That again creates this sort of Goldilocks environment where, other than the political banter in Washington, there isn't much cause for volatility. Now, the concern with North Korea is a real concern, and I believe that Ed O'Brien pointed out that the president has threatened perhaps a military confrontation. That's an option on the table. Of course, we all believe that would not be a good option to utilize. And he's also threatened trade sanctions against countries that do business with North Korea. If he takes that to the full extent of his threat, so to speak, that could include China. So any of these factors, whether it's trade sanctions with China or other countries doing business with North Korea, or some sort of limited military action with North Korea, could create volatility. The fallout from the natural disasters that part of the world is suffering from right now with hurricanes Harvey and Irma could also have created and will create some volatility. The unfortunate but realistic fact is that after a natural disaster like that, there's a period of rebuilding. That actually adds to economic growth, not subtracts from economic growth. So volatility has been low. It puts us on guard. It makes us focus on fundamentals even more. But the fundamentals right now are strong. They could be stronger, but they're strong enough to support the stock market that we have. And if there's a surprise, which they sometimes come unannounced, then we'll have greater volatility. So because of where we are at this point in the bull market, where we are with what's happening in Washington, where we are with the geopolitical situation, not just in North Korea, but Syria and Iran as well, and also the aggressiveness of Russia, we've tilted towards the defensive posture with our defensive strategies, which, by the way, are doing quite well this year. So our defensive strategies, maybe it's good stock picking that our investment committee has done, but our defensive strategies are giving our clients either close to or more than double-digit returns thus far this year.
Yeah, I have a couple more thoughts on that. And I agree with everything Bob said, but I think in my experience, you tend to get volatility when things go bad. And when things go bad in the equity markets, it tends to happen when there are unexpected negative earnings surprises. And we just haven't had that this year. The market leaders are hitting their numbers, they're hitting their revenues, they're hitting their earnings guidance. Most of the guidance tends to be, fairly positive. There aren't the big guide downs. And those are the things that tend to turn the market quickly. And we just haven't had that this year, and that's really a good thing. And I think part of that is because of the somewhat improving economy. Volatility on the upside tends to happen after some downside. You get a couple of down days, then you get a big up day. So I think the fact that we haven't had the big negative earnings surprises tends to dampen volatility. And another thought I had as I was listening to Bob speak is, and we had a chart on it, is consumer confidence is at a post-global recession high. So I think that investors are very, they're happy, they're energetic, they're with what's going on, and I just don't, see a lot of, big selling coming into the market as long as there's high consumer confidence. So those are kind of my two thoughts.
Let me add one thing to that. It's Bob again. At the height of the market in 1999-2000, I was playing golf. I was on a trip to Florida, and the caddy was giving me stock tips, and and the taxi cab drivers were giving me stock tips. I remember calling Ralph at that time and saying, I think we got a problem here. You don't have that type of irrational market exuberance, to quote Alan Greenspan, former Fed chair. There's a real skepticism towards where equity markets are today. But again, when people turn and they look at what they're getting for a cash, which is basically zero, or what they're getting for a 10-year treasury, today it's below 2.1%. Or we often look each Tuesday when we have an investment committee meeting, a 5-year AAA municipal bond is yielding about 1.15%, below the rate of inflation. All of these are factors contributing to why investing in equities that have an earnings yield of almost 6% versus a treasury yield of 2.1% makes the equity market and the high quality companies in the equity market still attractive to us with the strong fundamentals that we've mentioned before. So it's an interesting time to be an investor. It's not an easy time to be an investor because the alternatives don't look particularly attractive. And that's why we're slightly defensive, but nevertheless staying the course in primarily equity-based strategies.
Great. We got one or two other questions, but I actually think we've covered them. So with that, I just want to say thank you to everyone on the line. We hope you found this interesting and insightful. If you have friends or colleagues who you think would benefit from joining future events like this, please just let us know, and we'll be happy to include them on the invitation list. For the clients on the line, I'd like to remind you that our investment committee is always available to discuss your individual asset allocation. Just give us a call. And with that, we hope that everybody is safe and has a great afternoon. Thank you.